So one of the very common questions that I get asked on a very regular basis is, hey, so what's the interest rate? Or something like, hey, I heard they raised, or I heard they lowered the interest rate the other day, or are interest rates going down tomorrow, or something like that. So I wanted to address that. I wanted to address the whole topic of interest rates and how they're calculated and how it is you can figure out what your interest rate is going to be on any particular loan. But the first thing is it shows a fundamental misunderstanding. When you use the word interest rate, it shows a fundamental misunderstanding of how rates are presented on a daily basis in the first place. Every single day, every single lender issues their own rate sheet with multiple different rates that look exactly like this. Sometimes these sheets are 4, 5, and 6 pages long. Furthermore, rates change at least every single day. Oftentimes, they change multiple times in a day. The financial marketplace is always changing, the values of financial instruments are always changing, and mortgage rates change right along with it. With everything that's been going on recently, I've had some lenders actually change their rates 5, 6, or even 7 times in a single day. When I have a rate sheet, it will have a series of rates, each usually on a 1/8% or 0.125% apart, and it looks just like this. Each of those rates will also have a fee associated with it, expressed as a percentage of the loan amount. This fee will either be charged to the borrower for a lower rate or credited to the borrower for a higher rate, and it looks like this. According to this particular sheet, the 3 3/8% rate would cost 7/8% of the loan amount as a closing cost, but the 4 1/4% rate would yield a 7/8% credit back from the lender. And right in the middle at 3 3/4%, there's neither a cost nor a credit for that rate. To further complicate matters, not only is there an underlying rate from what I just showed you a second ago, there are also a series of adjustments that happen based upon a variety of criteria. Here are the typical adjustments that can impact an interest rate. Number 1, the occupancy of the property. A non-owner loan is more expensive than a second home loan, which is more expensive than an owner-occupied loan. Number 2 is the purpose of a loan. A cash-out refinance is more expensive than a rate and term refinance, which is more expensive than a purchase mortgage. Number 3 is the amount of equity. The higher the loan to value, the percentage of value that's financed, the more costly the loan. Number 4 is the type of property. A condo and a multi-unit property is more expensive than a single-family residence. Number 5 is the loan amount. Less than $50,000 and more than $510,400 are more expensive. The number 6 impact is credit scores. The lower your score, the more expensive your loan will be. Typically, a 740 or higher score gets the very best rate, and the rates get worse all the way down to the very bottom, to the lowest acceptable score, which is typically in the low 600s. The number 7 impact is the time commitment from the lender. A commitment for less of a time frame will not as be expensive as a longer one. Number 8 and the last adjustment are for locations. Certain states are more expensive than others. California is one of those states. So all of those 8 items, a very long list, can actually impact your interest rate and the rate you would get for a particular mortgage that you're looking for. Let's do a comparison and take a look at 2 exact same loan amounts that yield substantially different interest rates because of some of those criteria. First, here are the scenarios. Number 1 is an owner-occupied cash-out refinance with a 50% loan to value on a condo with borrowers with a 650 middle credit score. Number 2 is an owner-occupied purchase of a single-family residence at 90% LTV, a 10% down payment with a 780 credit score. So what I do is I go onto my little loan sifter application, which searches through the several dozen lenders that we work with. It allows me to input all of the various different details, and then it spits out the results. I'll do that for each of these loans, inputting the various details. I get the result from the refi, and it looks like this. And then I get a result on the purchase, and it looks like this. So here's a side-by-side comparison of the results. Note that they both start out with the exact same rate and fee. And by the way, I'm showing here the dollar amounts for the fee instead of the percentage, so it's easier to understand. But then the pricing changes based upon the purpose of the loan to value, the type of property involved, the loan amounts involved, and the credit score. When you get down to the very end, look and see the difference in the rates. Utilizing the roughly same credit on the $600,000 loan, scenario number 1 would have an interest rate of 4 1/8, but scenario 2 would have an interest rate of 3 1/2. So that may have been way a little too far into the weeds for you. You may just simply want to know, hey, you know what? What's my interest rate and how can I pay as little as money as possible for it? I can help you with that. But otherwise, you might want to know, how is my interest rate calculated? What are the factors that came into you giving me the interest rate quote, or somebody else giving me the interest rate quote that I got? And then what can I do to make changes to the type of loan that I'm getting, to the property I'm getting, all the other various different things to drive my borrowing costs lower? Now, if you have further questions or you want to talk about specifics, please contact me. Also, if you'd like to talk about selling your house or buying a house, I'd be happy to show you the strategies I use in those circumstances as well. My number is 949-413-2371, and my email address is michael@hausamgroup.com. Thank you so much and have a great day.